Tēnā tātou tātua. Welcome everyone to our latest Need to Know series focused on Tier 1 and Tier 2 not-for-profit entities. If you are not a Tier 1 and Tier 2 not-for-profit entity, there are previous Need to Know series that will provide you an accounting update relevant to those sectors. My name is Nimish Beta. I'm a Technical Director in the Accounting Standards team, and I'm pleased to be joined today by Liana Van Heerden and Carly Berry, two of our senior project managers in the Accounting Standards team, who have been working very hard on a couple of key exposures that we'll talk through today. The External Reporting Board is an independent Crown entity, and we're focused on promoting the trust, confidence, transparency and accountability of all entities in New Zealand through high quality external reporting. Ultimately, we are trying to get the right information to the right people at the right time, and we do that through our accounting standards, our audit and assurance standards, and our climate reporting standards. And the proposals we'll talk to you today contribute to that objective. So what will we cover today? On the next slide, we understand a lot of Tier 1 and Tier 2 not-for-profits are currently finishing up their financial reporting and audit processes, so it's a good time to start focusing on the future. And there's a lot of key areas that the ETSAB have been thinking about for not-for-profit entities' financial statements, including service performance reporting and developments around revenue and transfer expenses. So we'll talk through each of these key proposals in this session, and we'll also wrap it up with an update and reminders around incorporated society changes. And there'll be plenty of time for questions at the end of the session, so please do think about these questions and put them into the Q&A function at the bottom of your screen. And of course, the webinar slides and recording will be made available shortly after today's session, so you don't have to worry about making detailed notes as you go through today's presentation. So starting off on service performance reporting and assurance, we understand that this is a very critical area for a lot of Tier 1 and Tier 2 entities out there. This is a very key area of reporting, and the External Reporting Board are committed to ensuring that not-for-profit entities can report their service performance information in an appropriate and meaningful way to their users. So we have heard a lot of noise and a lot of tensions around entities trying to report their service performance information and auditors and other parties challenging how that information should be presented and exactly what type of information should be communicated in a statement of service performance. We've heard a lot of this feedback across a number of years ever since the reporting standard PBE FRS 48 was created and mandated in 2022. And so now we are going through a process of trying to understand exactly what these challenges are that entities are facing and how we can potentially shape the standard better going forward to allow for you to report the information in an appropriate way. So we have released this consultation paper around the reporting and assurance of service performance information, and that is currently live on our website. And we would encourage each and every one of you to read that consultation paper and see what we are considering in terms of challenges and potential solutions. So during our initial conversations with a number of Tier 1 and Tier 2 entities, we found certain areas where the standard is creating some challenges. There is potentially a lack of clarity around what exactly constitutes service performance information and what type of information should be included in a statement of service performance. We've heard a lot about how different not-for-profit entities are compared to public sector entities. The public sector have a detailed budget that comes out in May every year that outlines what outputs should be reported upon, but that doesn't exist in the not-for-profit sector. So the overall performance framework is very different. We've also heard a lot about the maturity of service performance reporting processes compared to financial reporting processes, and sometimes the controls and the documentation that you would expect and is embedded in the financial reporting processes just does not exist or is still in its infancy when talking about non-financial service performance reporting. And we've also heard a lot about the tension with auditors and how auditors are challenging the level of evidence that is needed to support their opinion on whether your service performance reporting is appropriate. So we really want to hear about these challenges. We want to understand from each individual entity what you are experiencing, what is causing you problems in terms of your ability to report the service performance information that you would like to report, and whether there's any tension within the reporting standard or the auditing standard that may stop and cause a barrier to being able to provide the information that is appropriate for your service performance. So on the next slide, we also talk about some potential solutions. We have been thinking about how do we respond to these particular challenges. And one way is to amend the reporting standard. So our consultation paper explores potential ways that we could amend the reporting standard to try and alleviate some of this tension and try and simplify some of these challenges. And some of the suggested solutions that we're thinking about is creating a more clearer purpose around what the nature of service performance information is to help facilitate entities to report the right types of information. We're considering aligning the actual PBE FRS 48 standard with the core principles of the PBE conceptual framework that will allow for consistent definitions and interpretations of financial terms with the non-financial terms within the context of service performance reporting. We are thinking about a basis of preparation requirement to allow for greater disclosures around how the information is constructed and the limitations and judgments that may be needed when preparing that information, so users can understand exactly what you are measuring and why you are measuring it. And we are also thinking about how we address individual characteristics of the not-for-profit sector compared to the public sector. And we are considering whether an authoritative appendix to the standard, which will only apply to the not-for-profit sector and give particular interpretations and application to the not-for-profit sector, whether that would be useful. On the next slide, we also don't just do standard setting. As the XRB, we also do a number of non-authoritative guidance pieces. So we are thinking about what supplementary guidance we as a standard setter can provide across the existing principles to help entities in their service performance reporting. And we really want this to be a community of practice. We really want to find entities like yourselves to help develop this guidance. This isn't just us telling you how to report something. We really want each individual sector to come together and work out a way to find the information and performance measures that should be reported. So we are holding a number of in-person and virtual workshops across different sectors, some of the larger sectors in New Zealand, to bring people together to figure out a way to provide appropriate and meaningful service performance reporting. So we would encourage everyone to look at our events page, find these events in the sectors that works for you, and then how we can develop a set of performance measures or reporting frameworks that would work for each individual sector. On the assurance side, we're also thinking about what guidance we can write for audit practitioners to understand the level of evidence that they should be asking for and using to support their audit opinions. And that guidance is currently being worked on. So on the final slide, you may be wondering how you can provide feedback. And there are a number of different ways. You can go to our website You can attend one of our virtual or in-person events and give us verbal feedback. You can fill out one of our online feedback forms, which have been specifically tailored to individual sectors and streamlines the way that you report. You can email us at our email address. You can write us a letter. You can fax us a letter. You can attach a letter to a courier pigeon. I'm sure it will all make its way to us. We want to hear as much feedback as we possibly can because your feedback matters for this consultation. We will make changes and we will address your concerns and challenges if we know about them through our actions. So our consultation closes on Friday the 29th of August. You may think that's a relatively short period, but at this phase, we are really looking to understand what your challenges are in reporting this information. And having just gone through a reporting cycle, many entities have been going through that at the moment. I'm hoping those are front of mind. So it's a relatively easy process to communicate what those challenges will be to us as we look to try and make service performance reporting appropriate and work for the not-for-profit sector in New Zealand. So we're happy to take questions on service performance reporting, and we'll please pop them into the chat and we'll look through them throughout this webinar. But at this stage, I will pass you over to Liana Van Heerden to start talking about our new proposals on revenue and transfer expenses.
Thanks. Thanks, Nimesh. It's actually going to Carly first. So Carly, if you can get us kicked off with revenue and transfer expenses, please.
Yep, sure thing. Good afternoon, everyone. Liana and I are quite excited to discuss the proposals in EDPBE IPSAS 47 revenue and EDPBE IPSAS 48 transfer expenses. Let's start with a brief project overview. The proposals and these EDs aim to provide clearer guidance for revenue and transfer expense accounting and to improve the consistency, comparability, and transparency of financial reporting for public benefit entities. The EDs were developed using the International Public Sector Accounting Standards Board's IPSAS 47 revenue and IPSAS 48 transfer expenses as a starting point, with adjustments and enhancements to make the standards fit for purpose in the New Zealand environment. So please note the consultation period for these EDs closes on 1st of December 2025. The consultation is open for 6 months to allow for sufficient time to consider the proposals. Now, before we get into the detail of the proposals, over the next several slides, I want to highlight the extensive guidance available, both within the EDs themselves and also created by us. Firstly, to ensure the EDs work well for not-for-profit entities, we have made several enhancements specific for these entities. In the revenue ED, we have added implementation guidance for not-for-profits, covering donations, bequests, goods and services in kind. This implementation guidance is aligned with the guidance currently in PBE IPSAS 23. We have updated application guidance examples of binding arrangements involving services in kind and the internal use of resources to reflect New Zealand's environment and to align with examples currently in PBE IPSAS 23. We have also added an illustrative statement of comprehensive revenue and expenses for not-for-profits in PBE IPSAS 1 as part of the proposed consequential amendments made by the revenue ED to other PBE standards. And finally, in both the revenue and transfer expense EDs, we have adjusted some of the illustrative examples to include not-for-profit entities in the transactions. These changes make the EDs more relevant and practical for not-for-profit application. Now here, the EDs address common challenges by offering additional support for transactions like capital transfers, multi-year funding, appropriations, and services in kind. They also include extensive application and implementation guidance, plus 56 illustrative examples for revenue and 11 illustrative examples for transfer expenses to assist with practical implementation and application. And lastly, I want to highlight our educational materials and support shown on the slide here and highlighted in orange boxes throughout the presentation. These materials are available on our website. Now, we normally do not create educational materials for EDs, but we have done so for these ones to make it easier on everyone to understand the proposals, as they are quite lengthy. And with that, I'll now hand over to Liana to cover the binding arrangement principle.
Perfect. Thanks, Carly. So before we get to the proposal specific to revenue and transfer expense transactions, we'll take a look at the binding arrangement principle, which is fundamental to the accounting for both types of transactions. As you will see throughout this presentation, the existence or absence of a binding arrangement significantly affects how a revenue or transfer expense transaction is recognized, measured, presented, and disclosed in the financial statements. Therefore, understanding how to identify a binding arrangement is critical to applying the proposals in these EDs. So what exactly do we mean by binding arrangement? As defined in both EDs, a binding arrangement is an arrangement that confers both rights and obligations enforceable through legal or equivalent means on the parties to the arrangements. Such an arrangement does not need to be in writing, although this often will be the case. Let's take a look at the two key aspects of this definition. Firstly, the rights and obligations in the arrangement must be enforceable. In other words, an entity must have the ability to enforce the terms of the arrangement and hold the other party accountable due to consequences that will be faced in the event of non-compliance. The ability to enforce the terms of the arrangement arises due to enforcement mechanisms in the arrangement that can be through legal means or through means that are outside the legal system but are similar to the force of law. The EDs refer to these as equivalent means. The EDs include examples of enforcement mechanisms through equivalent means, with further guidance on whether those mechanisms may result in a binding arrangement or not. Some examples include cabinet or ministerial directives. Furthermore, an entity's customary practices, the operating environment, and past experiences with the other party are examples of other relevant factors to consider in the enforceability assessment of a binding arrangement. In terms of consequences that drive enforceability, these must have the ability to hold the other party accountable. Consequences can either be explicitly stated in the binding arrangement, but can also involve implicit consequences that arise from an entity's customary practices. The other key aspect of the definition is that there must be at least two parties to the arrangement that have their own enforceable rights and enforceable obligations. The rights and obligations of the two parties are interdependent and inseparable. Therefore, each party in the arrangement has both a right and an obligation. If one of the parties does not have a right and an obligation, then it is not a binding arrangement. In some arrangements, there may also be third-party beneficiaries that receives the promised goods or services in the arrangement. These third parties do not have enforceable rights and obligations under the arrangement. Finally, there needs to be at least one compliance obligation. This concept is applicable to revenue accounting and will be elaborated on shortly. You might ask, at what point do I assess if a binding arrangement exists? So this assessment is performed when the arrangement is entered into, but also when there are significant changes to the terms and conditions in the arrangement. Determining whether a binding arrangement exists may involve significant judgment, and therefore the EDs contain guidance to assist with this assessment. For a quick recap on the binding arrangement principle, as you work through the proposals in the ED, you can refer to this section of the presentation, or you can watch our webcast available on our website through the link provided on the slide. I'll now move over to the proposals in the revenue ED. Let's start by looking at our current PBE revenue standards, PBE IPSAS 9, 11, and 23. These revenue standards have caused several challenges. The two main challenges included the distinction between exchange and non-exchange transactions, which leads to uncertainty of which standard to apply. This has resulted in inconsistent revenue treatment. Secondly, under PBE IPSAS 23, a liability can only be recognized if it contains a return obligation, which result in large amounts of revenue being recognized upfront, whereas the expenses are only incurred in subsequent periods. Because of these and the other challenges on the slide, as well as the new revenue standard issued in the for-profit space, IFRS 15 revenue from contracts with customers, the IPSASB initiated their revenue project in 2015. Fast forward to May 2023, the IPSASB issued a single revenue standard, IPSAS 47, which supersedes the three existing revenue standards. As previously mentioned, we used IPSAS 47 as the starting point for developing this revenue ED and made adjustments to make it fit for purpose for New Zealand's public benefit entities. Before we get into the detail of the revenue ED, I will focus on the benefits and costs of the proposals. The proposed revenue standard provides a robust and structured framework that supports public benefit entities to apply revenue requirements consistently, improving transparency and comparability, and ultimately resulting in higher quality financial reporting. In terms of coherence, important to note is that the core principles in this proposed revenue standard are consistent with those of the proposed transfer expense ED, which we'll move on to shortly. Additionally, because the proposed revenue ED aligns closely with the for-profit revenue standard, comprehensive guidance and educational material is available. It also simplifies reporting for mixed groups and supports workforce mobility. Unfortunately, change comes with costs, which will mainly involve time and resources to understand the new requirements and make necessary adjustments. This will be especially demanding during transition. There will likely also be ongoing costs for periodic training of new staff. However, overall, we expect the benefits of the proposals to outweigh the costs. Now, moving over to the proposals in ED PBE IPSAS 47, which is a single revenue standard centered around whether a transaction arises with or without a binding arrangement. The recognition and measurement requirements for revenue differ under the two accounting models focused whether a binding arrangement exists or not. There are several new terms in the revenue ED. Some will be further explained as we go along, but for now, I want to note the resource provider, who is the entity giving the cash or other assets in the revenue transaction, and then also the resource recipient who receives those resources and is the reporting entity in the revenue transaction. Finally, we have developed a short webcast that provides a summary of the key proposals in the revenue ED. You can access this webcast on our website through the link provided on the slide. Before we go into the detailed requirements for transactions without binding arrangements, I want to highlight an example that may be familiar to not-for-profit entities, being a bequest without specific terms for the use of the funds. In these cases, the resource provider, being the deceased estate, doesn't have enforceable rights over how the funds are used, and the not-for-profit entity doesn't have an enforceable obligation to use the funds in a specific manner. So this type of bequest is typically considered revenue without a binding arrangement for the not-for-profit entity as the reporting entity. I'd encourage you to keep this example in mind as we walk through the proposals for how to account for revenue without binding arrangements. So, for these transactions, revenue is recognized as the obligations are satisfied or immediately if there are no enforceable obligations. Assets and liabilities are recognized if the conceptual framework definition of assets or liabilities are met. I'm not going to elaborate on the measurement criteria of revenue, assets, and liabilities, as those mostly align to the criteria for transactions with binding arrangements, which will be covered shortly. Instead, I want to focus on another transaction that may be familiar to not-for-profit entities, which is inventory received in kind, that will likely be a transaction without binding arrangements. So the Revenue ED retains the New Zealand specific exemption, which is currently available in PBE IPSAS 23, that allows entities not to recognize inventory received in kind at acquisition if fair value can't be practically determined. This responds to previous concerns from charity shops in New Zealand receiving high volume, low value donated goods where the cost of valuation outweighs the benefit. Now we'll move over to revenue transactions with binding arrangements. But before we get into the detail, I want to highlight again a common example being capital transfers. So these types of transactions will involve enforceable rights and enforceable obligations on both parties. For instance, the resource provider will have an obligation to provide the funds and a right that funds will be used to construct a non-financial asset, while the resource recipient, being the not-for-profit and reporting entity, has a corresponding right to the funds and an obligation to use the funds as agreed. I'd suggest keeping capital transfers in mind as a revenue transaction with binding arrangement as we go through the upcoming slides. So, as previously mentioned, the accounting for revenue transactions with binding arrangements are closely aligned with the requirements in the for-profit revenue standard. The recognition and measurement principles for revenue transactions with binding arrangements centers around the compliance obligation in the arrangement. Each binding arrangement needs to have at least one compliance obligation. This brings us to the compliance obligation definition, which is an entity's promise in a binding arrangement to either use resources internally for distinct goods or services, or transfer distinct goods or services to a purchaser or third-party beneficiary. The delivery of the compliance obligation, in other words, the distinct goods or services, drives when and how revenue will be recognized, as well as whether or not liabilities or assets can be recognized. Therefore, in binding arrangement transactions, compliance obligations become the unit of account. A 5-step revenue recognition model is followed as follows. Step 1, identify the binding arrangement. Second step is to identify the distinct goods or services. Third step is determining the transaction price. Fourth step is to allocate the transaction price to compliance obligations. And the last step is to recognize revenue as each compliance obligation is satisfied. Now that we've covered the compliance obligation principle, we can move on to the more detailed recognition and measurement principles for transactions with binding arrangements. As noted in the previous slide, binding arrangement revenue is recognized according to a 5-step revenue recognition model. Based on this, compliance obligations can either be recognized at a point in time or over time. Any remaining compliance obligations for which resources have been received, but goods or services have not yet been delivered, are recognized as a binding arrangement liability. On the contra side, a binding arrangement asset is recognized when goods or services has been delivered, but the entity does not yet have an unconditional right to receive payment. In terms of measurement, revenue is measured at the amount received or receivable. The revenue ED contains various requirements on the measurement principle, focusing on variable considerations such as discounts, significant financing costs, and non-cash components, and so on, which will impact the amount of revenue recognized. On the other side, assets are initially measured at the transaction consideration amount when the criteria for asset recognition is met. Similarly, liabilities are measured at the required amount to settle the compliance obligation, limited to the transaction consideration. It should also be noted that when there is one transaction consideration received, but multiple compliance obligations need to be delivered, the transaction consideration should be proportioned to the different compliance obligations based on a standalone value basis. So a standalone value basis of the compliance obligation can be the price that the good or service trades for in the market, or a cost plus markup basis, or a residual amount, or lastly, a combination of these methods. Some examples of revenue transactions with binding arrangements includes capital transfers, as previously mentioned, and grant agreements with compliance obligations. One big change to note in the revenue ED is that compliance obligations can arise from promises to use resources internally or transfer to third-party beneficiaries, which also means that deferral of revenue can occur for these types of transactions. Specifically, when resources have been received for internal use under a binding arrangement, and the compliance obligation has not yet been satisfied, revenue can be deferred due to consequences an entity will face in the event of non-compliance, which has to result in unavoidable transfer of resources to another party. Now, let's move on to presentation and disclosure requirements. This revenue ED requires entities to present binding arrangement assets and liabilities separately, along with receivables where there is an unconditional right to consideration. Revenue must be presented in accordance with PBE IPSAS 1, and major classes of revenue should be shown either on the face of the financial statements or in the notes. For disclosure, the requirements in the revenue ED aim to help users understand the nature, amount, timing, and uncertainty of revenue and related cash flows. The proposed disclosure requirements align with the requirements in PBE IPSAS 23 and the for-profit revenue standard. And similarly, the disclosure concessions for Tier 2 PBEs also align with RDR concessions currently available in PBE IPSAS 23 and the for-profit revenue standard. This brings us to the end of the revenue ED. I'll now hand over to Carly to cover the transfer expense ED.
Thank you, Liana. So I'll now have to ask you to switch perspectives and consider the accounting from the point of view of a reporting entity that incurs transfer expenses. First of all, what do we mean by a transfer expense? It is an expense arising from a transaction other than taxes, in which an entity provides a good, service, or other asset to another entity or individual without directly receiving any good, service, or asset in return. The entity providing the resources is referred to as the transfer provider in the transfer expenses ED, and the entity receiving the resources is the transfer recipient. Examples of transfer expenses may include grants and donations, given in cash or other assets, and social welfare payments. Now, before we go any further, let's take a look at the expected benefits of the proposals. So a key benefit is that PBE IPSAS 48 transfer expenses would fill the current gap in PBE standards as there are currently no specific requirements addressing the accounting for transfer expenses. By filling this gap, PBE IPSAS 48 would allow for increased consistency in the reporting of transfer expenses across the PBE sectors using the latest international thinking. Other benefits include guidance on challenging accounting issues and the alignment of key principles for transfer expense accounting with those in ED PBE IPSAS 47 revenue. Change comes at a cost, so we expect that similar to the revenue ED, implementing the proposals would require time and resources and would potentially create challenges with the introduction of new areas of judgment. But overall, we expect the benefits of the proposals to outweigh the costs. Now, this slide sets out some of the key features of the transfer expenses ED. The accounting for transfer expenses is driven by whether the transfer provider has an enforceable right to have the transfer recipient satisfy its agreed upon obligations in return for receiving resources. Such a right is referred to as a transfer right in the ED. For a transfer provider to have a transfer right, there must be a binding arrangement. Ultimately, transfer expense transactions require different accounting treatment depending on whether or not they involve a binding arrangement. Therefore, similar to the revenue ED, there are two models of accounting for transfer expenses, as shown in the diagram here. There are several new terms to become familiar with, some of which are listed here and that I have already mentioned. I'll introduce you to some more of these as we go through the presentation. And finally, we have developed a short webcast that provides a summary of the key proposals in the transfer expenses ED. You can access this webcast on our website through the link in the slide. Let's now take a look at the transfer expenses from transactions with binding arrangements model. As we go through the next few slides, we'll use an example whereby the transfer provider is a large charitable trust that enters into a binding arrangement with the transfer recipient to build a new community center. We will refer to the transfer recipient as entity A. Under a transfer expense transaction with a binding arrangement, the transfer provider must identify the number of distinct and separately enforceable rights that it has to the transfer recipient's performance under the binding arrangement. There will always be one such right, which is the transfer right that I mentioned previously. Some examples of a transfer provider's rights are shown in the box on the slide. Now, typically, the number of distinct enforceable rights will be evident from the negotiations between the parties. And in some cases, multiple rights would have to be aggregated in order to produce a distinct right that can be enforced separately. In our example, entity A has agreed to perform the overall management of the build, as well as other tasks necessary for the build, such as design and engineering. Within the context of the binding arrangement, these rights are all highly interdependent and interrelated, as the individual services together result in the building of the new community center. Therefore, the charitable trust aggregates these related rights into a single transfer right, which is the right to have entity A build the community center. It is important to determine the number of transfer rights within the binding arrangement because transfer rights provide the basis of the timing of recognition for transfer expenses when the transfer rights are recognized as assets. So I've spoken about transfer rights. Now we need to establish when these rights would be recognized as assets in the financial statements. But before I get to this, what about transfer obligations? Now remember, for an arrangement to be binding, both parties will need to have enforceable rights and obligations. For the charitable trust, its obligation is to transfer resources such as cash to entity A in return for building the community center. These resources are referred to as transfer consideration and are allocated to the transfer rights, or in this example, to the single transfer right. More detail on how this is done later. So before either party has begun to perform under the arrangement, each party has interdependent and inseparable rights and obligations, and therefore, technically speaking, a combined asset and liability, which is measured at 0. So recognition of an asset or liability in the financial statements relating to these rights and obligations will therefore depend on which party starts to perform first under the arrangement. So for example, if a charitable trust transfers some or all of the funds to entity A before entity A has engaged in the agreed upon activities, the charitable trust would recognize a transfer right asset, representing its right to entity A's performance under the arrangement. In cases where entity A performs or starts to perform under the arrangement before receiving the funds, the charitable trust would recognize a transfer obligation liability for the resources owed to the recipient. So let's have a look at recognition of the transfer expense. As noted on the slide here, there are two ways that a transfer expense is recognized. Where there is a transfer right asset recognized, the expense is recognized as or when the asset is derecognized, which occurs when the transfer provider no longer has enforceable rights in accordance with the binding arrangement. Typically, this occurs when or as the transfer recipient satisfies its obligations under the arrangement. Where the transfer provider's rights are reduced as the transfer recipient satisfies its obligations, this results in a gradual derecognition of the transfer right asset and the recognition of the transfer expense. In our example, this would occur as entity A constructs a community center. In this situation, the charitable trust must be able to reliably estimate entity A's progress towards complete satisfaction of its obligations. Let's assume that the charitable trust can do so using a measure of costs spent on the construction activities. In cases where the charitable trust could not reliably estimate entity A's progress, derecognition of the transfer right asset would have to occur immediately, as it then cannot be reliably measured. Where the transfer recipient is unable or unwilling to perform in accordance with the binding arrangement, the transfer right asset may either be impaired or derecognized with the financial asset recognized in its place. This would happen where, under the terms of the binding arrangement, the transfer provider is entitled to receive cash as a result of the non-performance. Now, where there is a transfer obligation liability recognized, the corresponding expense is recognized at the same time as this liability. As noted on the previous slide, this liability is recognized when the transfer recipient performs first. A transfer obligation liability could also be recognized when there is variable consideration in the binding arrangement. This could happen when the transfer provider's obligation to transfer resources is contingent on the occurrence or non-occurrence of a future event, such as additional funding becoming payable if the transfer recipient satisfies its obligations within a specified period. Variable consideration may also result from items such as, for example, discounts or rebates. Variable consideration is accounted for as a provision under PB IPSAS 19, where the definition and recognition criteria for a provision are met and is measured in accordance with that standard. Now, when measuring the transfer expense, the transfer provider must consider the terms of the binding arrangement to determine the transfer consideration, which, as mentioned previously, are the resources that the transfer provider is required to transfer to the recipient. Specifically, the transfer consideration is the total carrying amount of these resources and includes the effects of variable consideration, if any. When determining the transfer consideration, the transfer provider must assume that the transfer recipient will perform and that the binding arrangement will not be cancelled, modified, or renewed. I mentioned previously that transfer consideration is allocated to the transfer rights in a binding arrangement. This is either done in accordance with the binding arrangement, when the allocation is specified there, or by determining the best estimate of amounts intended to compensate the transfer recipient for its performance. Therefore, as a relevant transfer right is extinguished, the transfer expense is measured at the amount of the transfer consideration allocated to the extinguished transfer right. Now, in our example, the charitable trust only has the one transfer right, and therefore the transfer consideration is allocated in its entirety to this right. Now let's move on to the second accounting model, which is transfer expenses from transactions without binding arrangements. Where there is no binding arrangement, there can be no transfer right asset, but the transfer provider may still have a legal or constructive obligation to transfer resources to the recipient. Therefore, the first step here is to determine whether the transfer provider has a provision recognized in accordance with PB IPSAS 19. If no provision is recognized, the transfer provider will recognize the transfer expense when it no longer controls the resources and will measure the expense at the amount of the transferred resources. Where provision is recognized, the expense will be recognized at the same time as the provision and measured in accordance with PBE IPSAS 19. Now, to finish up this section, I'll briefly touch on the presentation and disclosure requirements in the ED. Transfer right assets and transfer obligation liabilities are similar in nature to prepayment assets and transfers payable, respectively. There is guidance in PBE IPSAS 1 relating to the presentation of these. In the Statement of Comprehensive Revenue and Expense, the transfer expense is presented as a single line item or by program or purpose, depending on whether the nature or function method is used to present expenses. Transfer providers are required to disclose qualitative and quantitative information about their material transfers to enable users to understand how the entity's resources are spent on its programs, activities, and services, as well as qualitative and quantitative information about the material transfer arrangements. For those transactions with binding arrangements, additional disclosure is required relating to the realization of transfer right assets and significant judgments around their recognition. We have also proposed to provide disclosure concessions for Tier 2 entities relating to some of these requirements. Presentation and disclosure required by other PBE standards are also relevant, depending on the types of assets and liabilities arising from a transfer expense transaction. This now brings us to the end of the revenue and transfer expenses section of this presentation. As mentioned earlier, this consultation closes on 1st of December 2025, and we'd really value your feedback on these proposals. So please take a moment to share your thoughts, either by email or through the link on our website, which is shown here on the slide. I shall now pass back to Nimish.
Thanks, Carly. And I appreciate that's a lot of detail and a lot of information around proposed new requirements on revenue and transfer expenses. These are very important requirements, and they may have quite significant impacts on your accounting for fundamental revenue and transfer expenses streams. So I would echo Carly's call to consider these requirements. There is a number of months for you to work through these impacts and then provide us your feedback as you get to that. So, and as part of this session, please do put any further questions that you have as you've been hearing Liana and Carly's presentation into the Q&A function. While we wait for those questions to populate more, I wanted to provide a quick reminder around changes on and for incorporated societies. So many of us work with incorporated societies, and we all may be part of an individual incorporated society. The legislation around incorporated societies is changing and has changed. This is not done by the XRB. This was done by Parliament directly, and the new Incorporated Societies Act of 2022 is now in effect. That Incorporated Societies Act requires incorporated societies to re-register with the Companies Office by the 5th of April 2026 in order to maintain their incorporated society status. And as part of that re-registration process, there are a few new requirements that the Act requires an incorporated society to consider, and that very well may impact on the rules that is within each incorporated society's constitution. So if you do work with an incorporated society or you are a part of one, I would highly encourage you to raise this with the incorporated society to make sure that they are aware that there is a re-registration process with the Companies Office that is required by April next year to maintain the incorporated society status. What I wanted to focus upon is the financial reporting implications that occur as a result of being an incorporated society. So the new Incorporated Societies Act creates a requirement for financial statements to be prepared in a particular way, given what type of incorporated society you are. And it creates legislative definitions of what different types of incorporated societies are and the resulting financial reporting implications due to that. So if you are a specified not-for-profit entity, you are required to prepare financial statements that comply with GAAP. If you are a small society, you are required to prepare financial statements that are prepared with GAAP or non-GAAP standard or the simplified reporting requirements directly within the Incorporated Societies Act. And for any other case, you are required to follow the general PBE tiers within the accounting standards framework. So on the next slide, I just wanted to provide a quick overview of what these legislative types of societies are. Again, the ETSAB is just the messenger here. We didn't create these definitions or these thresholds, but these are baked into the Incorporated Societies Act directly. So if your society has less than $50,000 in the last 2 financial periods of operating payments and current assets, and is not a registered charity or approved donee organization, you have the full flexibility of reporting under any of our GAAP PBE standards, our non-GAAP Tier 4 PBE standard, or the simplified reporting requirements directly within the Act. As you move up and become a larger incorporated society, if you have more than $140,000 of operating payments in the last 2 financial years, you will become the legal definition of a specified not-for-profit entity and be required to produce GAAP-compliant financial statements, which will be PBE Tier 1, 2, or 3. And if you're in between that gap, between a small society and a specified not-for-profit entity, you will follow our general PBE tier reporting requirements, which will be between PBE tiers 1, 2, and 3, and 4. So it's really important to just be aware of these different legislative thresholds and just how it will impact the financial statements that need to be prepared by that society once they go through that re-registration process. There is a bit of time to do that, but April 2026 will be fast upon us, I'm sure. So it's worth considering that now, particularly if the society needs to change and amend their constitution to allow for that re-registration to happen. So with that, we are happy to take questions on anything that we've covered in today's session. And as people put their questions into the Q&A function, we just wanted to talk through some quick questions that have been raised with us in previous sessions. We have been engaging with a lot of entities previously, and we believe there's some questions that I'm sure are on your mind that might be very helpful to just hear a direct response to. So the first question I wanted to ask is to Liana, and just to ask whether the concept of a binding arrangement and whether the arrangement has to be binding for both the resource provider and the resource recipient.
So thanks for that question, Nimesh, and that is one that has come up before. So the answer is not necessarily. So each of the parties, both the resource provider and the resource recipient, needs to assess from their own perspective whether they have both enforceable rights and enforceable obligations, and whether the other party, in their opinion, also has enforceable rights and enforceable obligations, but then also need to take into account the other factors that may be relevant in concluding whether that arrangement is enforceable. So it might not necessarily be that both parties come to the conclusion that both have a binding arrangement or both does not have a binding arrangement. So it doesn't necessarily have to overlap.
And we also have a question around whether revenue can be recognised under an arrangement if there are no particular obligations specified in the agreement itself, but it does require a certain output, like a report to be prepared throughout the period.
So I think it will depend on the terms. So as previously noted, you need to take into account other factors. So it might be that a binding arrangement does not always need to be in writing, but it often is in writing. So you need to take into account the other factors of dealing with the other party and whether both of you have enforceable rights and enforceable obligations, and that you can hold each other accountable to those rights and obligations to determine whether you have a binding arrangement or not. So I think that one is, again, depending on the terms of the arrangement and the interaction between the parties involved.
And I think it's important to note that an agreement doesn't have to say it is an obligation for it to be an obligation. That wording may very well be used, but in most situations, no one's going to specifically say this is the obligation.
And it can also be that obligations, so as you say, they're not explicitly stated somewhere, but they are implied by your customary practices. So it might be that generally, because of what you've done in the past and what is expected of you to do, that is an expected obligation of you to deliver or to perform a good, a specific service.
And moving on to a question on transfer expenses, which will be addressed to Carly. There is a question around whether the 1 January 2029 effective date will allow enough time for entities to prepare in applying the PBE IPSAS 48, given transfer expenses may be a very large portion of a lot of not-for-profits spending. Do you have any views or comments on how that date of 1 January 2029 came about?
Thanks for that question. Yes, I can understand there may be some concern around the fact that this is a brand new standard and therefore is there enough time to implement it. But we are expecting to issue a final standard in the third quarter of 2026. So this would give entities over 2 years to prepare for implementation. And in addition, in the transfer expenses ED, we are proposing to allow entities to apply the standard prospectively to all transfers occurring on or after the date of initial application, which should also help to reduce the cost and time to implement the standard. And also in the revenue ED, there are practical expedients available upon transition as well. So there is some relief for entities when implementing the standard, which should help to just make it easier in terms of timing.
We have a question on service performance assurance and around whether a post-implementation review of the audit standard NZAS1 revised will be planned, and if so, whether that would be aligned with the timing of any potential revisions to the reporting standard PBE FRS 48. And I think at this stage, the required auditing standard NZAS1 revised is still not yet effective. So it is difficult for us to think about doing a post-implementation review of a standard that is still not yet mandatory. So at this stage, we are not planning to do any amendments with the revised auditing standard, but to approach any challenges with the assurance of service performance information through guidance. With our normal due processes, we will look to do a post-implementation review of that standard at some stage in the future. But as of right now, we are focusing our attention on just the reporting standard and supplementing that with guidance to reporters and assurance practitioners. We do have one other question which is quite specific to a particular entity, and I can appreciate why that question was being asked, as it seems like a very unique situation and a very difficult situation. To that attendee, I would encourage you to send us a quick email with your question, and we will consider that further and then look to reply to you with a more nuanced and particular response, given that is a very tailored and specific situation. And in the last few minutes, if there are any further questions, please do pop them into the chat. But in the last few minutes, I would just like to encourage everyone to read and reflect upon the consultation papers and exposure drafts that we have talked through today. We are tackling issues like service performance reporting, revenue recognition, and transfer expense recognition. These are big areas that will impact all Tier 1 and Tier 2 not-for-profit entities. If you've not got something, if you don't have a particular view on revenue or expenses or service performance reporting, there might be something wrong there. So I would encourage you to look through these exposure drafts, provide us your views. We are very open to tailoring these requirements to make them work for not-for-profit entities. So we do value and appreciate your feedback, and it does help us in our decision-making and our processes to develop standards that work for you and work for your users. We have a particular question around whether statutory fees and levies, such as practicing certificate fees paid by professionals to their not-for-profit regulator, would be considered as a binding arrangement.
Sure, thanks. So those kind of fees, it would determine, or you would need to take a look, and it might depend on those specific terms with what those fees relate to. So is there enforceable rights and enforceable obligations for both parties to the fees? So if you are receiving those fees, do you have an enforceable obligation to deliver in terms of those fees received? And also, does the party who provides the fees have an enforceable right for you to deliver based on the terms of your arrangement? So again, it goes back to depends on the scenario and what it entails and the arrangement between the parties.
Great, thank you for that, Liana. And with that, I think we are bang on time for the session. If you do have any further questions, please email us at accounting@xrb.govt.nz and we'll respond with a more specific and tailored response to your question. Thank you all very much and enjoy the rest of your afternoon.